Hi everyone, I'm going to talk to you guys about interest-only loans and sinking funds now. So, an interest-only loan is where you only pay the interest amount on the loan. You're not actually paying off your loan. So if I show you a little example, say you get a loan for $30,000 and it's over 10 years. And what happens with a reducing balance loan is it exponentially goes down like that. So at the 10-year mark, you will have $0 owing on your loan and you will have paid it all off. With an interest-only loan, you have, again, $30,000. This is the 10-year mark, and the balance of the loan will stay the same at the 10-year mark, and then it will go down in one payment because you pay it off in a lump sum amount. So what that means is that while your interest repayments will be quite low, you will at the same time have to be saving money to make sure you have that lump sum at the end. And the part where you're saving money is the sinking fund. So a sinking fund essentially is a savings account, but for a specific purpose. So this, you would have a savings account and it is specifically for whatever your loan is, whatever you took the loan out for. So let's do a question and hopefully it makes a bit more sense when we put it into context. All right, so we've got, I've taken a loan for $16,000 to upgrade the computer network for my part-time business. I've arranged for loan repayments to be interest only, and I will repay the loan in full at the end of the 5 years, and I'm going to do that with a sinking fund. Interest in my savings, so my savings interest is 4.25% compounded monthly. The loan interest is 8.5%. So to find the interest payments, it's I equals P times I times N. So principal times interest rate times number of years. So it'll be 16, this is our simple interest formula, 1,000 times 0.0875, so it's your percentage as a decimal, times by, I want to make monthly payments. So N is always number of years, so I want what 1/12 of a year is, because I want a monthly payment. And that comes out to be $116.67 per month. All right, so now I want to know how much I also need to put into my sinking fund to make sure I have that $16,000 at the end of the 5 years. So this will be 5 times by 12. The interest rate was 4.25%. I'm starting out with nothing in the account. I'm looking for what my payment needs to be. I need my future value to be 16,000, and both of these are 12. When I put all of that into TVM mode, my payment comes out to be $239.81. Then it asks me how much will be in the sinking fund in 3 years' time. So I would do 3 times 12, still my 4.25%, 0, my PMT will now be negative 23981. Future value, is what I'm looking for. And then both of these will be 12. So the value of the account in 3 years would be $9,190.36. And the final part to this question says, what is the book value of the debt? So that is the loan minus the amount in your sinking fund. So that would be 16,000, take away 9,190.36. So the book value debt is $6,809.64. Awesome. And that's that question done. Okay, so we're going to do one more question on interest-only loans and sinking funds, and then hopefully you can do some yourself. All right, so with this one, John borrowed $30,000. His debt's to be paid in 5 years by building up a sinking fund. The interest on the debt is 10.8%, paid half yearly, and the sinking fund payments is 5.8% compounded half yearly as well. So to find the interest, it's I equals P times I times N. So the principal is 30,000 times by 10.8% as a decimal and half yearly. So it would be 1 out of 2 times a year. And that would give a value of $1,620. So every half year, $1,620 will be paid. Then part B says calculate the half yearly deposits required for the sinking fund. So it's done twice a year for 5 years. The interest is 5.8%. We start with 0. We're looking for the payments. The future value needs to be 30,000, and payments per year and compounds per year are 2 because it's half yearly. And that gives a PMT value of $2,628.99. So every half year, this amount would need to be deposited into the sinking fund, so that savings account. So then it says, what is the total cost to the borrower? So it's the total amount of interest repayments. So they made 10 repayments in total of $1,620 plus the total savings deposits. So again, they would have made 10 deposits, and those amounts were 2628.99. So when we add these together, the total cost comes out to be $42,489.90. So that's how much it cost John to borrow $30,000. Then it says, what is the total paid to the lender? So it's the interest payments, which are 10 lots of $1,620 plus the actual loan amount. So that bank gets your 10 lots of this plus your $30,000, which comes out to be $46,200. Oops, too many zeros. So then the last part says account for the difference between the two accounts. So that if I do $46,200, take away 42,489.9, get a value of $3,710.10. So the bank got given this much money, but John only had to save this much money. So this is John's expense, and this is what the bank gets. And the reason that this amount is more is because this is how much interest the sinking fund gets. So that means that John actually earned $3,700 through interest that he could use to pay onto the loan. And that's it for interest-only loans and sinking funds. Bye.